So you were just saying that you'd be going long the gold miners, which leads me to believe that you'd want to go long gold, and I got to ask you why.
Well, quarter end is a wonderful time to take advantage of capitulation. Because as
you think that we've seen that?
This is one of the great of all time, one of the great moments of true capitulation in the sector. I mean, this is portfolio managers, asset managers around the world that have had an overcrowded trade in gold are getting the tap on the shoulder from risk managers and alike, and they're just saying, hey, cut this position in half. So you have too many people heading for the exits. There's a fire in the theater. People are jumping over their seats. They're hanging by the chandeliers. They're trying to get out through the bathroom window.
Right.
And that's when I want to get in.
But there's a reason why the fire's been lit, right? I mean, we have rising interest rates, so rising real yields, a stronger U.S. dollar. The Fed might exit their bond buying program. I mean, what's the reason to own gold?
Well, just the fact that it's on the short term for the next month, it's classically oversold. The second thing is that I think that the gold cycle, we're in the middle innings, really. A lot of people bought gold because we have $6 trillion of easing around the world with the Bank of Japan, the Bank of England, the Fed. Sure, the U.S. is first out. So as the U.S. is first out of QE, that strengthens the dollar, that's weakening gold. So that's created an exit here. But if the U.S. economy improves, as that's why the Fed is in theory, that's why the Fed is doing this tapering, then that's going to bring back some inflationary fears, and then you'll have another run-up in gold.
Future inflation. I got to get a skeptic in here. I got to get someone who's looking at $1,200, $1,100 gold, and for that, I go to BNP Paribas head of commodity strategy, Harry Tchilinguirian. Harry, help me out here. Are you a bull here like Larry is?
No, I'm afraid not. We think that the Fed has sealed the fate of gold with the June FOMC. The fact that Bernanke hinted at a potential exit of QE by mid-2014 is going to focus the market on the flow of asset purchases rather than the total stock of assets the Federal Reserve is going to hold in its balance sheet. And as the market is forward-looking, I think that with that view that there will be eventual tapering, maybe by December, and after that, if things go well, and an exit, then we don't see how gold is going to be able to get a leg up here and move higher.
But Harry, what do you make of the argument, though, that once growth picks up here in the U.S., that we will see inflation, like Larry mentioned, and the fact that we've seen capitulation, so there's just this mad rush to the exit, so it's kind of, you have to buy?
I believe to some degree we have obviously sell-offs that are related to capitulation. I take that point on board. But, you know, in the end, how much inflationary pressure is going to be generated out of a recovery in the U.S. economy? I mean, we're far away from potential economic growth. So if we do get a recovery, I don't think that that's going to be pushing core inflation higher. You look at the realized figures in core inflation, they're quite contained. Look at the five-year expectations in terms of break-even rates. We're looking at declining inflation expectation. So we're not in a position right now to say that there'll be such inflationary bias in the future that will help gold higher. At the same time, we shouldn't forget that the dollar is strengthened relative to currencies of emerging markets that are important physical actors, if you will. The Turkish currency, the Indian currency have all depreciated against gold, and therefore that limits their amount of physical gold demand, which is also an important and influential factor in the market.
Harry, you bring up a good point, and so Larry, I want to get your take on that. If we're in a disinflationary environment, and we're also seeing a lack of physical buying, China, India, which has really stabilized the price in the past, what do you make of that?
Well, I look at it more like on a technical basis, right? So you look at the miners, look at the ETFs like the GDX. You look at the amount of shares that have been traded in the last month. In some cases, like 60, 70, 150% of the shares outstanding have traded in the last 20 days, 10 days. So in other words, the new investor base owns the gold miners down here. So technically, there's a lot less potential pain because everybody owned the gold and the miners much higher. Now a new investor base has come in.
And you're seeing that flow.
Yeah, we're seeing new shareholders come in. So technically, I agree, gold could go lower. But I just think the miners themselves versus especially the XLE, which is the oil names, I think there's a 60% differential between those two. I want to be long gold miners and short oil.
Really quick question on the gold miners, though. I mean, they have so many problems. I mean, all-in cash costs are $1,200. They are losing money right now. They have rising labor costs, rising energy costs. I mean, what fundamentally do you like about them?
Well, at the top, you know, when gold was 1,900, all the strategists on the street were bullish. Okay, so at the top, there's always reasons why things are going higher. And at the bottom, when you get down the bottom, there's always reasons why things are going lower. The toughest thing to do as a trader, as an investor, is to get in there at the greatest moment of fear. Because my bottom line point is, at my greatest moment of fear, at the end of the day, it's almost like the Costanza principle. You want to do the exact opposite of what you want to do.
All right, so if we're going to have some investors, Harry, do the exact opposite of what we're seeing in the market, do you expect some short-term bounces here for gold?
Well, I think gold could bounce off technical support levels, but the general direction is lower. And at the same time, I think you can't confuse what the commodity is going to do with what the equity related to that commodity is going to do. So there are a lot of factors that distinguish the two, and I don't think you could draw parallels in terms of how one is going to perform and how the other is going to perform in a similar fashion. The bottom line is that gold is facing multiple headwinds, and of course, as the market starts pricing in the exit of QE or even the tapering of QE, we're going to see nominal yields rise, and we've seen that on the 10-year Treasury. And as inflation expectations decline, obviously the expectation of real positive rates rises, and then as a result, of course, that is very bearish for gold. So there's not much over the next 6 months to a year that allows us to be positive on gold. The Fed has sealed gold's fate. We're going to have the market focusing on the flow of asset purchases that will be tapering, not the stock of assets that the Fed is going to be holding.